In this video, I'm going to teach you everything you need to know about credit spreads so that by the end of this, you can actually do it and trade it and make money on a consistent basis. You'll see things like best practices. How should we be doing it? How does the overall market do it and why? You'll also see results from others who have done this and implemented this for themselves, who I have taught and have done well with it. And so here's the game plan for this training. You will learn why trade credit spreads, how to structure the credit spreads, like what DT should pick, strikes, and all that, how to manage the credit spreads, what are the main risk factors when it comes to trading them, and how can we mitigate those risks so that our performance is actually consistent and we don't have random huge losses, how to size your account and how to scale if you have a small account or large, what to do with each one. Let me move my face so that this is a bit better, make it smaller, get it out of the way. You'll also learn all those best practices, but you'll also learn how I personally trade it. You can see why I make certain adjustments and how it leads to a better performance. And you'll also get to see how to trade it in different markets. Again, there's different markets. You have bullish, bearish, neutral, and how should you adjust it for each one. You'll learn about the advantages and disadvantages of it so that you can learn what's good, what's bad, and so you can make a good decision about if this strategy is a good fit for you. And you'll also see a real trading example. I will dive in to a whiteboard to map out exactly how this strategy works so you can actually understand it. I will go into the broker, pick out the strike prices to show you how it actually works. So by the time you get done with this video, you can walk away and actually be able to implement this to make real money. I'll also, as a bonus and cherry on top, show you how to automate the strategy so that you can actually do all of this hands-free. Sweet. So before we get into the fun stuff, I need to cover a legal disclaimer, which is this is for educational and entertainment purposes only. I'm not a financial advisor. 99% of you will lose money. Past performance, whether mine, somebody else's, or a back test, does not guarantee future results, and all of your trades are 100% your responsibility. So if things don't work, it's not my fault. If you agree to this, let's continue to the training. If you don't, sorry, you gotta leave now. All right, so why trade credit spreads? They are a simple mechanical strategy. What does this mean? It means that every single week we just do the same thing. So instead of trying to find new stocks, new strategies, new assets, all these things, instead we do the same thing every week. This leads to consistency, which leads to profits. Next, there is no complex chart reading. You don't need to know how to read a chart to do this and make money. However, I will show you later. We'll actually share my screen and the chart and we'll walk through how to do it. If you read the chart, you can actually perform better. But if you still want to make money, you don't have to read charts. It's easy to scale, whether it's a small or large account, you can do this. A decent win rate, about a 75% plus. Since our risks are capped on this, that's pretty good. There's no risk to the upside. Again, if we're put credit spread, the market can go as high as it wants and we'll still make money. It requires less buying power. So unlike selling a normal put, this will take less money, which means it's great for small accounts, or just means it's great for people who want to take less risk. Now, how do we structure the credit spread trade? How does this come together? Before we do this, we need to know what is the goal of this trade. This goal of this trade is to generate income in trending and directional markets. What does this mean? It means when the market is going a certain direction, whether up, down, or sideways, we can use a credit spread to take advantage of that. And so here's best practices around a credit spread based on backtests done by Tasty Live. You can see here, days until expiration is 45 days. Then you go 45 days out into the future. Strike selection is how do we pick the options? We're going to sell the 30 delta put and we're going to buy the 10 delta long put. So we're going to sell 30 delta, buy 10 delta. Now again, I'll walk you through this here in a broker in about 5 minutes, so stay tuned. Now for the credit target, we're looking to get about $20 to $40 of credit. So if we're looking to actually enter this trade, we want to make sure it's between $20 and $40. Now, what are the ideal assets to trade this on? Obviously, I love futures because they get greater return, which I'll show you later in this video. But so futures would be ES, GC, CL. So that'd be the S&P 500, or gold and crude oil. We can also do this on SPX and SPY for stocks and ETFs. That's how we structure the trade. Now, how do we actually manage the trade? We do take profit rules about 25 to 50%. This is typically best practice. The stop losses, most people do not use a stop loss for this trade because by default, this trade is defined risk. We're selling a put and then we're capping our risk by buying a put below it. And this automatically defines our risk. If we want less risk, we'll just make the distance between them smaller. The smaller the distance, the less risk we have. The further the distance, the more risk we have. And I'd be like, why would you want more risk? Because the further away, the more risk, but also the more profit. And so that's how you balance that. So Because there is a defined risk for this trade by default, we don't have a stop loss, and we typically just manage early at about 21 days. So when there's 21 days left in the trade, we'll close it out. So that's how we manage it. Now, what are the three biggest risks with credit spreads so that we can keep that in mind so that we can mitigate against them? Number one is market risk. So what is this problem? A market crash could result in a lot of large losses. So again, if we have 4, 5, 6 credit spreads open at a single time and the market drops hard, we could then see a lot of losses compound against us. And so again, not really the best situation for us because we then have to hold that trade out, which would be fine and probably work in our favor, who knows, but holding through that is never fun. So the solution is using an indicator to warn you of potential crashes. And when I share my screen and show you the chart, I'll actually be showing you a free indicator and a way to use it that almost nobody else does so that you can actually mitigate that risk. Risk number two is manipulation risk. So the problem here is when you use a stop loss or a limit order, it can lead to losses due to market makers manipulating the option price. Those were a lot of words. What does that mean? It means that when you have an order sitting out on the market and you're waiting for it to get filled, whether it's a stop loss because you want to protect your downside or a limit order because you only want to get in at a certain price. When you have that order sitting out on the market, other people can see it and they know, hey, if I can move the option price to get to that level, it will automatically trigger that and I can take advantage of it. So market makers, hedge funds, they read these orders and they manipulate the market to trigger your trade to close early when it shouldn't have. So you lose money for no reason and they take advantage of it and make the money on it. So that's why it's bad. So if you ever set a stop loss or a limit order and it closed prematurely, that's why. So how do we solve this? We only submit an order when we're ready to enter or exit. So if we're ready to enter, then we submit a limit order at the mid price. If we're ready to exit, then we submit a close order at the mid price. And so that's how we can do it. Now, again, as I'll show at the very end how to automate this, the automation will handle this for us so that our order is never on the market so that it's kept safe and protected. Now, risk number three is volatility risk. So if VIX spikes, which usually goes from a low level to a high level, it spikes up. This can lead to huge and sudden losses as well. Now, because we're doing a credit spread, our risk is capped. So we'll see those losses spike up, but again, only to a certain amount because our risk is capped, which is nice, but still VIX spikes will lead to huge intraday losses. Now, the solution is to adjust your buying power based on VIX. So if VIX is at higher risk, we can do the same trade, but less of them. Or if VIX is at a high risk point, we can do the same amount of trades, but makes our width smaller so that our risk on the trade is lower. Those are two. Now, how do we size our account and scale based on where we're at? We need to keep in mind the 30% rule. This really helps keep our account balanced and make sure that we're not trading more than we should. And so if you should have no more than 30% of your account into trades. This means for easy math, if you have a $100,000 account, you should have no more than $30,000 of it in active trades. So with that in mind, if we have less than $10,000 in our account, then we should do one trade at a time, only one trade active at a time on SPY. If we have a $10,000 to $25,000 account, we can do once a week on SPY, so a once a week basis, but doing it on SPY, which is a smaller asset. If we have $25,000 to $100,000, we can do this trade once a week on SPX, a larger asset. Again, if you're doing it on futures, this would correlate to that as well. It'd be on ES, and so you can do it on a larger asset. If you have 100,000 or more, then you can do it twice a week on SPX or ES futures options, and then scale the contract size from there. You typically don't want to go past doing it twice a week, so like Tuesday, Thursday. You'll just then, after you maxed out that, then scale the contract. So instead of doing one credit spread, they'll do 2, then 3, then 4. So now that you've learned all the best practices around it, I'm going to show you how I personally trade it, how I adjust it to give me a better win rate and more smooth and more consistent returns, and why I made those changes so that you can adjust those for other strategies you have. So my goal is the same thing. I want to generate monthly income with very low risk and as little buying power as I can. That way I can generate a good return on my money and do so consistently so that I can actually generate an income and retirement and never have to worry about it. So what I do is I do days until expiration. Instead of 45 days, I go out 90 days. Why? The further out in time you go, the higher your win rate is, the less volatility risk you have, and you get to make more money. And so why is this? Because the further amount or the further out on time you go, the more time you have for the trade to be right, which decreases your risk. You also get to, because there's more time, there's more theta decay available to make, so you collect more profit. And it also increases your win rate because further out in time means further strikes, which means you're further away from the stock, which you'll see here in a little bit when I chart this out on whiteboard. Strike selection. How do I pick my strikes personally? In general, most people do a 30 delta for their credit spreads. I prefer to have a higher win rate. So instead of doing a 30 delta, I do a 20 delta short. So I sell the 20 delta put and then I buy the 10 delta put. And so that way I'm further away from the stock, which increases my win rate and leads to a more consistent return. I'll show you the back of this here in a second. I'm still able to actually credit roughly the same target. Depends on where volatility is. Sometimes it's closer to 20, but still I'm in the same credit target range. My take profit, I like to take profit faster. So instead of like 50% normal take profit, which is typically best practice, I go on the lower side of that, about 20 cents. That way, as a 25% take profit, my trades are closing faster, which means I have less trades open at a time, which means I have less risk on in the market. And so that's why I do that. I also do an early management of 21 days. This is standard in best practice as well. On the assets I use, ES, SPX, and SPY are the main assets. I typically like to stay with ES and SPX. Why? Tax advantages, section 1256, I believe is the name of it. And so I get to basically pay less taxes on the profits I make if I do it on futures options or if I do it on SPX. Now, here's the back test of my setup of the rules I just explained to you. Again, you can see it's more consistent, more stable. You do have those red days and red periods. We can see here where we do drop again around 2020, 2018, things like that, 2018, 2020. And then again, you can see here the decline in 2022. We had that slower downtrending period. We can see here 2 weeks to close the trade. Not bad. Average winner about $500. Average loser about $7,000. So again, you will have those larger losses, but they're still capped, which is nice. Now, again, you can add a stop loss to this to decrease the risk, but it is also at the same time going to affect your win rate. Overall, the great strategy here. And remember, this is on SPX. So if you want to do this on SPY, just divide all this by 10. So your max loser would be $700 about, and your average winner, say average loser would be about $700, and your average winner would be about $50, $60. So again, if you want to do it on SPY for smaller accounts versus what we're showing is on SPX. Now again, here's the one based on best practices. Obviously, you can see here does well, 87% win rate. There just seems to be more jagged, more downside action versus this one is a bit smoother, up with a 97.5% win rate. So that's why those are the settings I made. Pushing it further out in time, having a smaller take profit, and kind of moving my deltas further away. So that gives me a smoother curve on my return. How do I trade credit spreads in different markets? Okay. What about bullish markets? Bullish markets are defined as higher highs and higher lows. That means the market is moving higher. It's moving upward. If that is true, I'm going to follow the ideal trade setup, which is going to be on base practices, or if I'm using mine, whichever one you want to use, you're just going to follow that typical setup. Because again, credit spreads are made to profit in upward markets. Now, if we're in a bearish market, which means the lower lows and lower highs, the market continuously going down, that means we should consider just staying out of the market as a whole. Why? Because put credit spreads do not make money when the market is trending down. So there's no reason to get into them at that point unless the market starts reversing, but that's a different story. If the market's just consistently trending down, something you want to stay out of, you can even reverse it and do a call credit spread instead, which will make money to the downside, but that's a different game. We have a sideways market, which means we're stuck between the same support and same resistance level. The market's just bouncing up and down between those two levels. If that's happening, we still follow the normal best practice setup and whatever setup you want to follow, because that will make money on time decay, because the market's doing nothing in general, it's going up and down, but time is moving on, which means we collect that theta decay profit. So what are some of the advantages of using a credit spread? So it generates consistent income as you result from the results, not a 97.5% win rate. It's very easy to set up. It's just two options, and you don't really do anything outside of that, meaning there's very little adjustments. You just put the trade on a weekly basis, depending on your account size, and you just let it go. Now, this can be stacked for continuous income. As I mentioned, if we do it once a week or twice a week, we'll then have a lot of positions open and closing and opening at the same time, creating basically a perpetual income stream. It also requires less buying power. So it's small account friendly, or if you're just someone who wants to take less risk, again, you can do it this way compared to selling a put. So again, it has the same type of profile where it works about the same. Just this way you get to define your risk. You have caps downside risk. So again, your risk to the downside is capped to a certain amount, but also to that, you have defined profits, is what to say as well. So you have defined profits as well. And this can be played in all different types of ways. You can do different underlyings, different expirations, different widths of the spread, and things like that. What are some of the disadvantages of credit spreads? Potential for large losses. Again, if you have a lot of them going at a time, you can then have losses on all of them. It can be complicated if you're new to options. Hopefully not too much. I'm about to walk you through it so that you can see it and be able to do it yourself. So stay tuned. I'll be showing my broker here soon. I require strict buying power management. You want to make sure you're on top of how much money you have in trades and how much you're using so that you're not using too much or over trading. Again, if you want to protect your risk even more, you can hedge it. That will cost additional money. You have capped profits. That also means capped losses, good and bad. And you have assignment risk, which means you can be assigning shares if you're not trading something that has no assignment risk like futures or SPX. Sweet, let's dive into a real trade example. I'll show you a whiteboard. I'll walk you through everything I just talked through, give you a visual, then we'll dive into the broker so you can see exactly how this is done. So here's the visual, so you can understand all these numbers I just gave you and see a visual of it, okay? So let's say this is a stock. It's just minding its own business and trending up. What a great stock. What we're doing here with the put credit spread, all we're doing is that we're betting that this stock will go higher, or AKA we're betting the stock will stay above a certain level. So you can see here, I can go all the way down here and bet that the stock will stay above this. How do I do this? I do this by selling put. So I'm saying minus P, selling put. And then right down here, I define my risk by buying a put. This is what a put credit spread is. Sell put, buy put. And again, both of these are below the stock. And that means as long as the stock stays above this level right here, can I star? That's a star. Above this level right here, the short put, then I make money. That means if the market goes up, I make money. If the market goes sideways, I make money. If the market goes down, I make money as long as it stays above my level. If the market breaks here, that's where I start losing money at expiration. So that's what you want to keep in mind. Unlike a stock where you have to make money on the way up and you only make money there and you lose money down, this gives me so many more options to make money. Up, down, sideways, whatever, I make money unless it crashes my level down here, which is why you can have those very high win rates on these trades. And so again, that's how this works, and that's the spread difference. Whatever the distance of this spread is, that's going to be your risk. And so again, you can use that as your risk. Again, the greater the distance between those two options, the more risk you have, the more profit you make. The shorter the distance, the less risk and less profit. So that's how that works. That is what a put credit spread looks like on a chart, how it looks like, where you make money from it, and things like that. Now, how do we actually do this in the broker? And so if I share my screen here, refresh the page so that it loads, sometimes you need to refresh. Anyways, you can see here how I'm running strategies just like this and doing pretty well, not too bad here. And so let me show you how to actually do this. So I'm going to go to the trade tab. Like I mentioned, I love doing these on futures options because they give me more buying power. So I'll just show an example with ES. But again, you can do this on any asset. Again, that is liquid options. First thing I'm looking at here when I see the options chain, which is what this page is called, is in the middle, shows me my expiration dates, when different contracts expire. And so like I mentioned, I look closest to 90 days for this. And so I'm going to look for a strike that has closest to 90D, which stands for 90 days. So if I scroll down, you can see here, there's a 95D. So this is 95 days. You can see I do have some positions here already because I like doing that, but 95D is closest to 95 days or 90 days. So I'm going to click on this. Now on the right side of this, middle column is going to be my put contracts. So this is going to be where I do it. Now remember for me, I sell the 20 delta and I buy the 10 delta. So this is what it looks like. First, I need to make sure that the broker is showing me the delta. So I'm going to click on this column, make sure it's showing me delta. From there, I then want to find the 20 delta. So that's going to look like 0.20. Now, if you can't find the exact 0.20, just find the next closest. Whether that's 19 or 21, you can pick that. But 0.20, 20 delta, perfect. I'm going to sell this contract. Then I'm going to scroll up a bit. I'm going to find the 10 delta or the closest one to it. It's right here, 10 delta. I'm going to buy this contract. Sweet. So now that we've done that, we can now look at the numbers for this trade. You can see here about an 80% win rate, which is really good. This is standard, right? But since I'm closing the trade early at a 25% profit, that's what pushes my win rate higher. You can see here, my max profit is about $1,500, and I'm putting up a little less than $4,000 to be in this trade. So let's look at the math to understand this better. I have the max potential to make $1,500. And so if I'm going to multiply this out, what I'm going to do is I'm going to multiply it by 25 because that's my 25% profit. So 25% profit, that gives me a max profit of $375. So again, if I'm looking at this, $375 is the profit that I'm looking to target here. Now, how does this compare to the amount of money that I'm putting up for this trade? I'm putting up about $4,000 worth of money to be in this trade. So if I take this math and then divide it by 4,000, that means that I'm able to make a 9% return on my money. 9% return in 2 weeks. This trade takes about two weeks to close. So every 2 weeks, I'm making a 9% return on my money. And I have at least an 80% win rate, but if not more, if I close this trade early. And that's what makes this a great trade. And so that's what it's doing it on futures. If you do the same thing on an asset like SPY, again, SPY will be a lot cheaper for my smaller accounts. But again, you'll see the buying power return be slightly different. So we got to go to 95 days. That's closest to 90. Then I'm going to sell the 20 delta. So right here, sell this one. I'm going to buy the 10 delta. Just like this, my max profit is a lot smaller. My buying power is 3,000. Again, if I want to do less buying power, I just bring this one closer in. My buying power dropped from 3,000 to 1,300. So again, you can change it like that. But this is how I run it. So you can see right here, the big difference that futures makes over stock. You can see here my max profit is 300 with about $3,000 put into the trade. So if I do 300 times 25%, it means I'm going to make about $75 on this trade, and I'm putting up about 3,200. So I'm making about a 2% return on my money in about 2 weeks. So again, 2% compared to 9%. Obviously, both are great. A 2% return in 2 weeks is so much better than a bank would ever give you. But you can see that futures give you that extra advantage because of the leverage they give you. Anyways, that's how you structure it in the broker. Now, remember I said there's a lot of risk when it comes to credit spreads. And again, that dials around or is around market crash risk and volatility risk. So I want to quickly show you how to overcome those or best mitigate those. And so if we go here into the indicator section, no matter what charting platform you're using, whether TradingView or your broker, they have this. It is called Bollinger Bands, Bollinger, Bollinger Bands. From here, most people use the settings like this, but I'm going to show you a tweak that most people don't know. If you go into the settings, you can change the 20 to 200, and this is going to change everything for you, okay? So look, this changes what the setting we just changed, took the middle line and turned it from a 20-day moving average to a 200-day moving average, which means this shows us basically over a year period of where the asset should be trading, okay? So in this instance, it shows us this asset, which we're looking at, the ES, should be trading in this range, which means if we get out above it, it's most likely going to pull back. If we get below it, it's most likely going to push back up. So this is what we're seeing. So you probably see where I'm going here, right? If we break out of these ranges, it's very likely to pull back. So you can see here, we break out to the upside, it pulls back to the downside. Break out to the bottom side, they both break back up. And upside down, bottom side up. And how do we use this as option sellers? Whether we're doing put credit spreads or something else, this is an incredible tool, right? If the market starts breaking out above this range, we can then take off some of our trades to reduce our risk in the case that it pulls back against us. So that is a really great way to do it. We could also add hedges in this range. If the market starts getting above this range, we might want to put on more hedges, protect our downside, maybe do some inverse trades like call credit spreads, which will make money to the downside and help mitigate our risk more so that we're only spending money on hedges when we need to, because hedges can be a big cost. But if we only do it when we need to, that's going to save us money, but still provide us with downside protection. And then again, vice versa up down here. If we're way down here and we're about to head back up, we might as well sell put credit spreads because then we get profit on the upside and we've already gone down the lowest that we can. Easier, that would have saved you from 2020, from this little down period in 21, than this slower down peak in 2023. And so again, this is a great free tool to use to understand where's my risk in the market. Is it likely to keep trading in a range, or is it likely to pull down or pull up? So that's how we do that. Now we're looking at VIX. VIX helps us assess the volatility risk, okay? When VIX is low, we have higher risk. Why? When VIX is down here, there's a higher chance that it goes up. When VIX is up here, there's a higher chance that it moves back down. And as option sellers, our risk comes when VIX is down here. So remember I said we have that 30% rule. We put no more than 30% of our account into trades. what we should be doing is if the risk up here is the lowest risk for us, then this is where we should be doing 30% of our account in trades. If it's down here, we're at the higher risk, maybe we should only use 15% of our account. So that way we're still in trades, we're still generating a profit, but we're in less trades so that we don't have a big loss if big spikes, and then we have more money to take advantage of those moves. So that's how we mitigate those risks right there. So that's the screen share real trade example of actually how to put that into action. Hopefully you learned a lot. Everything I just gave you will show you how to do credit spreads and actually use them to make money. So go put that into action. Now, if you'd like to learn how to take those rules and automate them, that's exactly what I'm about to show you here in the next 5 minutes. Okay. So let's turn the strategy into a bot, aka hands-free passive income. So you can not only protect your downside, make some money, but also do so without being stuck to the screen. So you can actually enjoy retirement, spend time with your family, and actually enjoying the outdoors. So number one, you need to sign up for an automation software. So Option Alpha allows for automation. It allows for automation around put credit spread, which is great. So you can do that. It offers paper trading, which makes it great. The only downside here is support is slow if you need help. And also they don't support all the brokers, and they don't allow futures options, which is the biggest con. So if you want to do futures options, you wouldn't be able to do it on here. But still, if you want to do an SPX or SPY credit spread, you can do this on here. Now, Trade Steward, again, this allows for options automations. It does put credit spreads. It will allow you to do it on SPX and SPY, but not futures. Their support is slower. They only support one broker, so you have to make sure you use their broker. And they don't offer paper trading. So if you wanted to test this spot out before risking your own money, you wouldn't be able to do that. Now, you can also use the Options Auto Trader. This allows you to automate options, including futures options, stock options, index options, all of the above. So whether you want to do futures, SPX, SPY, you can do that here. It supports 4 different brokers, which is literally this is the only platform that supports the most brokers out of all the automation tools. If you need help with anything, you get support in less than 3 hours. And we offer paper trading. And you hear that? I said we? Yes, because this is the tool that I've spent a year painstakingly building, running my own 6-figure accounts off of, and have helped over 600 people generate monthly income using this software. And so again, that's why I'm sharing it with you. Again, it was built to be the best because it was built by a trader who didn't like the other one. Okay. Anyways, let's dive in. Step number 2 is connect your broker account. So once you have an automation tool that you can use, you then need to connect your broker account to it. And so the Options Auto Trader supports the most. We support Schwab, tastytrade, TradeStation, and Tradier. So if you have one of those, you're good to go. But once you connect your broker account, then you want to plug in the rules for this strategy. So take the rules I gave you and plug it into the bot. I'll show you a quick demo of that here in a second. Then from there, you'll let the bot run and generate monthly income. Here's an example of a bot that's made me $7,500 so far this month, which has been pretty great. So here's a quick 5-minute demo so you can see exactly how this works and how it's actually quite simple. Okay, so let's dive in. So this is an inside look of the Options Auto Trader. So I'm in the software. So that's the step 1. You need to sign up for the Options Auto Trader. Number 2, you need to connect your broker account, which I've already done. And then 3, you need to create your first bot based on the rules that I gave you. So I'm going to show you exactly how that works. Click on Create Auto Trader so you can create your bot. Next is you'll pick this blue one that says Create Auto Trader because you know all the rules you want to plug into it. Just like this, we're now going to pick these strategies. So again, we're running credit spreads. We're going to click on Credit Spreads. And then again, pick the asset you want to do. If you want to do SPY, SPX, or futures, you can do that. So again, ES is always a fun one to do it on, as I showed in the example earlier. I like to go 90 days out into the future. So I'm going to say 90 DTE. And then again, I do my credit spread where I sell the 20 delta. So -1 means sell. So I'm going to sell a contract at the 20 delta, then I'm going to buy one at the 10 delta. So this is how I personally structure mine. Next, now that I told it how I want it to execute a trade, now I need to tell it when to. And so when do I want this trade to enter? For most of you guys, you'll just be doing it once a week. If you have a larger account size, you'll do it twice a week and things like that, but I'll just do once a week for now. So once a week on Wednesday is what this is set to. So every Wednesday I'll place the trade. Next, how do I want the trade to be closed? Like I said, I do a 25% take profit. So take profit percentage, 25%. And I close the trade early at 21 days. So just like that, now once the trade is on, it'll manage the trade for me. And it'll do it based on a 25% profit and it'll close early at 21 days. From here, what I'm going to do is I'm going to set up some safeguards for the bot. How much money should I allow this bot to trade with? Like I mentioned, it's going to be around $4,000 or so for the bot to place a trade. So I'm going to put $5,000 here, and this should allow the bot to place at least one trade. So 5,000 here. But remember how I said market crash is very important and volatility risk is very important when it comes to credit spreads? Well, now with just a simple click of the button, I can enable that. So let's say I click enable this to VIX-based buying power. This means it's going to change how much money the bot is using based on where VIX is. You can see here, if VIX is 40 plus or VIX is higher, it's going to use the whole amount. If VIX is lower, meaning I'm at more risk, it's going to use less money. So just like that, I can automatically size my trading based on where VIX is without having to do anything because the bot will do it for me. And that's just one click. Now remember how we use the Bollinger Band to identify when the market was risky? I can enable this and it checks that for me. So just by enabling this, it will now get me out of positions when the market has that high chance of crashing. So when it starts to turn back down after breaking above, then it will actually start getting me out of positions to lower my risk because it knows the chance of it pulling back is quite high. So just like that, I've helped mitigate two of the biggest risks as an options trader, as an options seller, just by clicking two buttons. Next, click Save and Continue. You can review the bot settings, see what you want, all that stuff from here, which is great. And then once you set it live, that bot will be running, and you'll be able to track the trades, track the performance, and change the settings as you'd like. All right, guys, that's how simple it is. I hope that you see the Options Auto Trader, see it as awesome, regardless of whether you want to use automation or not. I've given you all the rules that you can actually put this into action. But if you are interested in doing a 30-day test drive of the Options Auto Trader, click the link down in the description below, or go to www.optionsautotrader.com/get started now to do your 30-day test drive. All right, guys, see you later and see you in the next video.